Okay, welcome everybody. So I see a couple of questions coming in. Emergency. Yes, I would say it is an emergency. So thank you for joining. It's been an absolutely insane day. So if you've been watching the markets, I started watching maybe here in Dubai, it's a little bit easier. So I guess I was watching since about 3:30 in the morning US time. For me, it's the afternoon. So of course I was just glued to my computer this afternoon. Feel like I ran a marathon. It was exhausting. I couldn't take my eyes off it. I'm doing all my work behind the scenes, trying to upload a video, trying to do a live stream. So this is a little bit impromptu. It's not scheduled. I didn't really plan a whole lot, so we're going to wing it. Apologies for probably the scatterbrain way that we're going to go about doing this, but it's one of those days where there's just going to be an enormous amount of questions. Obviously, we saw what is, in my opinion, the biggest overreaction of volatility that I have ever seen in my life. Now, obviously, something happened, right? I'm not saying it's nothing, but the VIX index spiking 180%. I mean, this hasn't happened since Black Monday, October 1987. So almost 40 years is what we saw today. I mean, I know there's some things to worry about. The market's pretty shaky, has been for a while. You've got the Japan thing going on. You've got rate issues. You've got every now and then we get headlines of war. But I mean, is it the biggest crisis in 40 years? I'm not so sure. So yeah, I would call it certainly plenty to worry about. And my strategies have been in safety for 10 days. So obviously volatility has been screaming warning signs for quite a while now. But worst day in 40 years, I don't think so. So don't be overly surprised if it fades back. We'll just, before we get started here, let's just take a peek at where we're at. Down minus 2.4% on the S&P. At one point, we were seeing this in the fours, down 4.3-ish. The VIX, let's go to the VIX. You can see this little thin candle up here. It got pretty crazy. I mean, it was in the teens 2 days ago, and then it went all the way up to 65. Basically, the largest VIX move ever. I mean, the VIX launched officially in 93. There's a back test using the same methodology back to 1990, and then if you use another back test using what's called the VRO, the VXO calculations with the S&P 100, we can see it back to 1986 and include October 1987. So officially, the VIX has never spiked this much ever, but unofficially, using the old calculation, Black Monday 1987 was definitely worse. But yeah, I see some things coming in. TOS crashed. I heard Schwab, Fidelity, sort of people posting on Twitter frantically. I actually had no issues. I trade with Interactive Brokers and Thinkorswim and Schwab, of course, now that it's been kind of taken over, and didn't have any issues. Now, I don't know if that was because I left everything logged in for basically the entire day, like 8 hours I was logged in. I didn't log out and then have to re-log in. So I don't really know, but I did see a lot of people saying that they had issues. So, wow. Okay, so like I said, impromptu emergency live stream here. I know there's going to be a million questions. We just close some of these windows. And I know there's going to be people trying to do trading, right? I mean, this is kind of an important time when you see these big spikes. People are going to be wondering, well, should I use options? Should I be buying things like buy and hold SVXY, SVIX, ZIVB, maybe the SVOL? Should I be shorting the UVXY outright and just, hang on for the ride that way? I kind of wanted to field some questions just so maybe, not saying you have to do what I say. There's many ways to short volatility. My method is just one, but maybe you can bounce a few ideas and we can at least brainstorm, because these are the types of days that people get themselves into trouble. Certainly leading up to it, I mean, in my personal opinion, everybody should have been in safety probably a week ago, but certainly several days ago. But it's really during these crises that people tend to make emotional errors. And so let's brainstorm some ideas. But before we do that, of course, most of today will just be an open Q&A. But I did want to cover a couple of things. So the first thing is, it kind of got lost in the mix, but I did just upload a video. So it's this video here. You might want to check it out. I think it's quite interesting. Like I said, people should have been in safety. This video is basically outlining the fact that we've been in safety positions since July 24th. So none of this craziness really affected our portfolio. in comparison to the S&P and the NASDAQ, we're crushing the market, of course, in the last 10 days. This video goes over that, shows some charts as to how that is, and I can actually show a couple of updates here. So basically what it is actually what I'll do, just for anybody who doesn't know how we trade here at VTS, we essentially, this is one of our 3 tactical strategies. They kind of all function the same. But we divide the market up into 3 segments, and then I'm using volatility metrics to choose which ETFs to hold. So stable markets, low volatility, we will be short vol, and that's where the bulk of the profit is coming from. But if volatility is elevated, we get the signal to move to safety and we go into gold. And then if it gets super elevated, we can move into long volatility. These are really only happening on about 2% of trading days, just to capitalize on what would be an extended recession, right? We're not trying to hit single days with this thing. It's impossible to time volatility like that. Basically, if this thing hangs out for a couple of months down, then that's what those positions are for. But we move to safety, July 24th, basically, we've been sitting in gold. And tactical or defensive rotation is the same. It's just NASDAQ, utilities, cash, and then strategic tail risk, kind of the same general idea. S&P 500, IYR real estate, and then VXZ for tail risk. But you can see this is the updated chart. That video that I uploaded shows the charts from last Friday. These are updated now. So you can see the differentials here on how much you can save yourself if you are willing to move to safety in your strategies. So for us, SVXY is our go-to short vol position. But again, we exited on the 24th. We parked in gold. Volatility's been signaling warning signs for quite a while now. So we just had the discipline to go. And it doesn't always pan out. I mean, sometimes you're in gold for a while, market calms down, and we're right back into SVXY. As it happened, we've been watching in horror. Of course, this time it really worked out quite well. So nearly a 30% differential there. That's pretty valuable for a portfolio to do that. Same with our NASDAQ strategy. XLU has been very smooth and calm. It's actually up money. Same with gold. 20% differential here. And then the third one, not quite as big, because IYR real estate isn't a positive market crash position. It's just better than stocks, but it does have that aspect where it will also go down in a crisis, but still 6% differential there. So I do want people to consider watching that video. I think it's an interesting little introduction to how we trade here at VTS. It's really not rocket science. If I could just general breakdown, I call it volatility targeting. We are essentially just aggressive positions, maybe 60 to 70% of the time, moving to safety roughly 30, 35% of the time, and then willing to go into tail risk maybe 2 to 3% of the time. And then we do have some option strategies as well. We've got an iron condor strategy. This kind of functions independently of the other ones. It's market neutral. It's got no correlation to stocks. And then we do UVXY butterflies as well. But yeah, crazy stuff. I mean, happy I'm in safety, comfortable watching the horror from the sidelines, but also pleased to see that gold held up, because sometimes gold, especially in the last few years, has crashed as well. So gold held up nicely, utilities held up nicely. It's all going pretty well. But that's my style of investing. Like I said, there's many ways to do this. I'm not saying that mine's the only way, but if you want to bounce some ideas off me, I have been doing this for 18 years. I've probably tried everything that you're thinking, hey, I wonder if that works. Trust me, I've tried it. I've modeled it. I've dumped a bunch of money, probably lost a bunch of money doing it. So yeah, that's what I'm here for. The second thing I wanted to talk about really quick, just so get everybody up to speed. If you want to see some charts, these are updated, I don't know, maybe an hour ago or something. But you can see these are the largest VXX spikes since VIX futures launched. That was March 26, 2004. You can see the VXX on August 2nd. That was last Friday when we did do a live stream and we were talking about how there's this insane volatility spike. Overreaction, of course, because the market was only down less than 2% by the end of the day. But VXX got spiked up huge. UVXY, of course, even more. But now today, look at August 5th, it's even worse. And certainly at one time today, it'd actually be interesting to calculate that. What was it at the absolute peaks. Let me get my calculator really quick. What have we got here? So let's check the high for VXX today was 91.02, and yesterday's close was 62.68. So it was up 45.21% at one point today. 45.21. So again, worse than the very bottom of COVID, worse than Brexit, worse than Volpocalypse, February 5th, 2018. I mean, that's what I'm saying. I understand it's a little bit scary, but is it really the worst crisis we've seen in 40 years? I think not. So don't be overly surprised if the market kind of bounces tomorrow and volatility gets suppressed a little bit. I would imagine, unless there's some serious follow through, I can't imagine that tomorrow isn't a much calmer day. Probably what was happening, you know, everybody's guess is as good as mine, but I suspect some pretty large firms somehow got themselves into some trouble because of what happened last Friday. Over the weekend, they're running numbers, or maybe regulators are kind of in the room, and basically there was some forced liquidating going on. And you can kind of tell that because typically if it's a panic sell, everybody's rushing to get hedging. What you'll see with the VIX is just it spikes up parabolically, right? That's not surprising. It'll hit a peak and then it'll start dropping down, and maybe it'll drop pretty quickly. But what we were seeing today, and I was watching it for 3-4 hours, it was just going up and up and up, and then it would go down a bit and then keep going up more and down and up more, and every time making higher highs. This is like 4 hours of selling. It typically doesn't work that way if it's just a panic hedge. So I suspect there was a lot of forced liquidations. And who knows, maybe the news will come out in a few days. We'll figure out which firms are now, you know, liquidated and bankrupt. Be pretty interesting. But yeah, for now, let's leave it there. Oh, I wanted to show one more chart. Interesting chart. Everybody needs to see this one as well. Because again, it shows, I mean, come on, where's that chart? Let me close that spreadsheet. Like I said, it was a bad day, but is it the worst day ever? I don't know. So February 5th, 2018, the VIX index spiked 115.6%. I know people are going to say, oh, the VIX is already a percent. Why are you quoting percent? We went through that last week. For volatility ETF traders, of course, you would quote it in percentage. So it is definitely relevant to use percentages. And it was up 180% at one point today. So just a comical volatility spike. I loved it personally. I mean, for me, as somebody who underperformed in 2022, one of the, say, 2 or 3 reasons we underperformed, I mean, one, because all assets were down, there was nowhere to hide, but also volatility was pretty muted in 2022. So you got a situation where I get most of my trade signals from volatility, and if it's muted, we were in aggressive positions a little bit too long. And we were kind of wondering, because I haven't had a bad period since 2008 basically, and always wondering, is that an outlier? Is that a one-off? Or is this just the new normal? Is volatility just not going to spike anymore? And 2023 behaved well. There was a couple spikes there that behaved very well. We exited fine. Performance was great. 2024 is all good. I think this shows that, yes, it's a nice little reminder. Markets go both ways. Volatility spikes up. Always manage your risk. Defined risk only if you're a volatility trader. I think today overall is a good thing. I can say that because we were in safety and we didn't lose any money, but I can also say it just as for the market itself and for the health and the future of the market, we do need to have volatility spike up when it's warranted. So I would say, good job. Scary to watch, especially if you were in the wrong positions. Feel bad for people who are scrambling around and watching their account go down. But overall, you have to see markets go both ways. Otherwise, it can really, really be bad long term. So good stuff. Maybe not 180% spike, but good stuff. All right. Let's answer some of these questions. There's got to be lots of these things. All right. I'm trying to short vol today by opening a put vertical spread on IB, but it seems to be impossible. The prices do not make any sense. Is buying SVXY a sensible alternative? So good question. This is going to happen probably now. Like, I don't know when you asked this, maybe 30 minutes ago, maybe. Maybe now it's behaving better. what you want to be worried about when you're trading options, not worried, but wary, is during fast-moving markets, premiums are going to be all over the place, especially when you're trying to do a multi-leg option spread. It quite often won't make any sense. Sometimes you'll look at iron condors and you've got the price there, and it'll say maybe it's $1.20, and then 2 seconds later it says $3.50, and then it's down to negative 60 cents and positive 180 cents. It'll bounce around a lot. So I mean, if at all possible, you shouldn't option trade when the markets are moving around quickly. Hopefully you positioned ahead of time and you wouldn't have the need to do that. But second part of this, SVXY and a vertical, I mean, these are entirely different trades, right? The risk-reward ratio on a vertical is quite good, and there's no volatility component because you've got a long and a short, so it's pretty good. It reduces the vega. I think that verticals, long put verticals, you could do short call verticals. They're mathematically exactly the same thing. You could do those, but SVXY is it's not a buy and hold instrument. You just can't do that. Of course, it can spike up violently, or in this case, go down to zero. It's just not the same thing. I mean, they're both technically, they're the same directional exposure, but these are not interchangeable. So if you can't do your vertical, I would not default to something that's just radically different. I would just be calm and patient. We check the market. It's kind of been at these levels, down about 2.5 for a while. I would imagine the premiums are starting to look normal. So yeah, give it another shot in an hour or so. Okay. I've always admired your work. I have a suggestion. Could you enable access to the barometers by integrating them into a dashboard on your website? Is that feasible? So I suppose what you're talking about is putting our, I would imagine, the volatility barometer, but maybe also our volatility metrics, like putting all of the dashboards on a website. I've never done that. I wouldn't do that. Of course, we've got a large community and everybody's sort of at a different place, both investing-wise. Some people are very experienced. Some people just don't really know what they're doing, but they're just blindly following what I'm doing. And also tech literacy. Like, I'm sort of on the low end of tech literacy, so I can kind of understand. But anytime you put things on websites and you have logins and passwords, you'd be amazed how many emails flood my inbox. So I have always chosen to just do everything in a single email, and then I only have to worry about whether people are actually getting the emails, which even these days is a difficult task because sometimes, I mean, I'm sending through Kajabi, sometimes through Gmail. They don't like when you're sending to 1,000 people. They think you're spamming everybody. So sometimes it'll just stop working and nobody will get the email. It's kind of hard enough as it is. But that's why there's also, I try to avoid logins and member areas and all that stuff. So I could sort of consider something. I don't think that, not to give you any false hope, I don't think there's anything on the horizon, but that's kind of the reason. I like to simplify everything. Email only. Yeah. Japan Exchange had the worst close in their history. I heard that. Biggest 2-day crash in the history of the index. Again, I get it. I mean, it's been something that I've been looking at for months now, and certain people have been talking about it as well, but worst ever? I don't know. I suspect, yeah, I'm not that type of trader to just jump in and put money on the line or anything, but I don't know. I could see a bounce. I could see this all calm down pretty quickly. Schwab's been horrible all morning. They had 15,000 outages reported. Yeah, I've heard that. Whenever I'm on Twitter, every time I refresh, more people are complaining about their brokers. Don't know. I had all of mine open the entire day. Nothing shut down on me. But just the sheer volume of things that were going on today all at once. I mean, I know that VIX options just went through the roof. I think it was somebody just before I logged in sent me something saying it was the highest volume since Volpocalypse. Yeah, it's going to cause some problems. Some people were hit on Thinkorswim, even logged in. Yeah, maybe I did get lucky. I don't know. Maybe because I'm outside the country as well. I have an international account. Maybe that was it. Maybe it shut down for everybody in the U.S. or something like that. Still can't log in. Am I seeing a beard? What's going on? I talked about this last week. My wife left a few days ago, and I've just been lazy, so haven't shaved. I don't know. Am I going to keep it, or eventually I'll get around to shaving in the morning one day? So when do you go long vol? It's rare. It's very rare for me personally, and the data supports it, and past performance for 15 years supports it. For me personally, I'm a trend follower. Being a contrarian is a terrible idea. So a lot of people go long volatility when volatility is low. They think that, well, it's so low, the VIX is 12. Certainly it's going to spike up any day now. The problem there is that it can stay low for months and months, and you can just bleed capital every day waiting for it to spike. So what I do is I wait for the trend signals to be like everybody's going to safety, markets are falling apart. That's the time to strike with long vol. And it really only signals, like I said, about 2% of the time, but those signals are only to capture the follow through on an eventual extended recession. Maybe not an extended recession, but something that lasts 3 or 4 weeks. I mean, the markets were down a little bit up until last Thursday, 3%, something like that. And then they fell off on Friday, another 2%. And now today, of course, big. But the market isn't actually down that much, even yet. I mean, we saw the VIX spike 180%. It's still not crazy market. We've seen it could go 10% more and it would be totally normal. We're only down at this point. I mean, it recovered a bit. We're probably only down 8% on the S&P, somewhere around there. So long vol for me personally is only to take the profit from, say, 7 or 8% down up until 20, 25. 56 in the financial crisis. That's when you want to go long volatility. But if you're trying to do long vol and just trying to strike and get these small wins on individual days, it's impossible. Nobody can time the signals that well. So for me, I am a trend follower. I short volatility during mid-low, and we go long volatility during extremely high. And that's how we do it. Again, it can be a little bit frustrating. So for example, we went... one of our positions went long vol today. And how we do it is through the M4 to M7 VIX futures product called VIXM. So most of the vol products are trading front month. I like to trade these ones here because you can see the futures are quite flat over here, and it's a slower moving product. So something like the VIXM, it doesn't spike up as fast as the VXX or the UVXY, but the benefit is during a crisis, it will go up, right? During, say, the financial crisis, S&P was down 56. I think the VIXM and the VXZ, they were up about 130%. So there's definitely some action there. If you go long vol and you get a recession, you can make over 100% return. The benefit, though, is that when you're wrong, and we might very well be wrong, right? Like I said, I think this is an overreaction in this market. I would not be surprised at all if that VIXM position is down tomorrow, but it's not going to get completely vol crushed like, say, if you were to use UVXY. That thing could be down 20, 30% tomorrow. So I like to use the midterm long volatility products, and you can actually take more swings at the pitch, basically, and not get completely destroyed when you're wrong. Because going long vol is a very frustrating trade. You are wrong quite often, and it doesn't kill you on the other side. So down a little bit, it would be fine. Kind of taking the risk that maybe lose a few percent tomorrow, but if it's beneficial, maybe we get a few weeks of really good long vol trades. Otherwise, get in day or two, get back out, bleed a little bit. It's kind of little paper cuts, but it's not that big a deal. Trend following. For some reason, the long vol, it's just such a tempting thing for people. And I've been there 10, 15 years ago. I used to do it too. I used to think, oh, market's got to crash any day now. You will definitely lose more money bleeding capital, waiting for the market crash, than you will eventually make when it actually does crash. So, yeah, it's just not a game that I play. All right, I know you've explained this countless times, but could you please remind me why SH, shorting the S&P, isn't part of our strategies? So let me do a little self-promotion here while I try to find the right blog article. If you go to my website, a lot of people don't know, but I do write articles, and I do post all the live streams and videos. most people follow me on YouTube and Twitter, but I do have a website and I do write quite a bit. So let's go to the articles. And my internet is crazy slow, apologies. And let's do short S&P and see if we can find an article. Come on the fly on a live stream. Why I don't short. It's got to be something. I mean, I know I've written 2 or 3 articles, but that search function seems to be letting me down here. Just give me one more second. Gold versus short S&P. This is the last shot. If this doesn't work, we're just going to move on with best asset class for low volatility. That is not, I can't believe it. Trust me, there are articles on my website. Sorry about that. So essentially the reason, let me just use hand gestures and whatnot. SH is a direct inverse of the S&P 500. So the problem there is that, of course, when you're wrong, you get hit with 100% of being wrong. But also, the worst time, the most punishing time can be during those down periods. So if you're dealing with something like, say, the VIXM, which I was just talking about, M4 to M7 product, it's actually in steep backwardation right now. So not only does it not punish you because volatility can be very sticky and it can stay for a few days, even if the market recovers, volatility signals and volatility metrics, they'll all kind of be sticky and you don't get killed on the way out. But markets can bounce really hard. And every time it goes down, that's kind of the time when the Fed will say something, the government will say something positive, and you'll get a really strong reversal. And that will crush you if you do the S&P. So what ends up happening is you just get these chunks down. And I wish I could pull up that article on the website. Trust me, it's on there. There's also a video on the YouTube channel, but I can't find it on the fly for some reason. But yes, the performance is miserable. When you compare something like SH versus our 3 safety positions, it's not even close, right? If we're comparing to our safety position of gold, gold is far superior to inverse stocks when volatility is high. XLU utilities is way, way better. SH, I think, is negative 5% annualized or something like that. These things, I think XLU is about up 8%. And that's only on 15% of trading days. The gap is insane. They just diverge immediately. So trust me, there is a quant reason why we don't use SH, inverse S&P. I hate to always just punt and say search the website, but trust me, this exact question is on there. I wish that search function didn't let me down. Okay, why are moves up or down so vicious in VIX? Anybody's guess? I don't know. I suspect, like I said, forced liquidations. Some big players out there got into some huge trouble, either over the weekend or, as soon as the futures opened. It wasn't that bad, but you can imagine that after last Friday, let's say there's a firm, this giant money firm that's in some trouble. And of course, over the weekend, they're all fingers crossed, if it opens up Monday positive, maybe we'll be okay. As soon as the futures open, it's down, what was it, 1.5, something like that. It's going to be a bad day. And the selling starts. And then the more selling, the more people are looking around like, well, now we're in trouble. And the more selling, more selling. Like I said, it lasted about 3 or 4 hours. So this was not a surprise panic, right? It wasn't a news headline or something like that. This was a planned, orderly mass liquidation of pretty large capital. So we'll have to wait for some news, but I suspect we're gonna find out what happened. This morning was a great time to have pre-planned, very aggressive iron condor pricing. Not every position fills, but the ones that do were in the green. Yeah, I don't do that. I just trade in the moment limit orders on my computer when I'm sitting in front of it. But yeah, certainly. I like how your mind is going to iron condors as well, because you got to remember that I was going to get into this a little bit when we're talking about trades, but when you're talking about what trades to open, when you are right in the middle of a massive volatility spike. The one problem that a lot of people have when they're trading options is, for some reason, they are trading them as if they are just trading stocks. They're just trading directional picks, and they're just using options instead of stocks. So maybe somebody thinks Apple's going to go up. They'll buy a long call on Apple. Maybe they think the S&P is going to crash. They'll buy a long put option on the S&P. They're basically just trading directional exposure, delta in this case, and they're using options to represent it. But that's not really option trading, right? Option trading involves multiple variables. There's many, many Greeks, but delta, theta, and vega being the primary ones you need to know about. Of course, delta, there's a directional aspect to it, but you also have to think about theta, which is basically what an option will be valued at with the passage of time. This is important because you might have a 2 or 3 month window open, but the really big one today, of course, is going to be vega. Now, if you buy a vega positive trade when the VIX index spikes 180%, you are paying the highest premium possible for that option. And so what ends up happening is, and I'll probably throw a video together tonight on this subject. This is very, very important for people to know today, that if you buy something that's vega positive today, you're paying a fortune for that contract. And even if you get the direction right, as soon as volatility crushes and gets taken out of the market, those premiums are going to absolutely collapse. So there's going to be a lot of people a few weeks from now, they're going to be on Twitter screaming like, what is going on? I picked this option and I nailed the direction perfectly. Maybe they bought a VIX put option. They're like, what's going on? It was 60 and I bought a put option and now the VIX is 30 and I'm down money. This is what's happening. You bought something when the vega was, the VIX was 65, basically. This is a terrible trade. So you got to remember that options have multiple layers. So to bring it back to your trade here, your comment here, iron condors are vega negative. So essentially, when that premium gets sucked out of the trade, that trade, that iron condor, even though directionally or price-wise, maybe it hasn't nearly moved into the proper range yet, it can actually be profitable extremely quickly because this is a trade that is profitable when volatility declines, right? So you do, on days like today, you don't want to be thinking long put options, long call options. Those are extremely expensive. You want to be thinking, butterflies, iron condors, diagonals, vertical spreads, any multi-leg option spread that has both long and short strikes in it. That's going to be your best bet because at least neutralizes the vega position. Like a vertical put spread on the VIX is far superior today to a long put option on the VIX. Same directional exposure, but the long vertical has both a short and a long, so the vega factor is extremely low. Iron condor is going to be negative vega, so that's going to be very beneficial. So just know that. And I like, you were throwing on iron condor seems pretty early, probably putting in orders ahead of time, and some of the crazy ones got filled. That's good. They're probably already up, 20, 30% just in a few hours. That can happen if you allow the option Greeks to work in your favor instead of fighting against them. You can actually profit from options very quickly, especially on days like today. Or you can just get hammered. I mean, I feel bad for all the people that just rushed in and bought long put options on VXX or UVXY. They're going to find that those are not going to make them any money. So, unfortunately. But I'll throw a video together tonight and hopefully put it on the channel tomorrow. All right. What would cause a large tracking error between VIX and VXX? Well, there is no tracking error. If you mean the VIX literally, the VIX index is derived from S&P 500 options, and the VXX is based on VIX futures. Totally separate markets. VIX S&P options and VIX futures are both totally freely traded markets. They're not the same thing. There's obviously a correlation between VIX and VXX and all of those things, but there's no causation there. So they can decouple all the time. There can be times when, for whatever reason, I mean, your guess is as good as mine, maybe the large firms happen to be hedging in the S&P 500 options market. So maybe the VIX would overreact compared to VIX futures and the volatility ETFs. This time around, it definitely seems pretty clear to me that the volatility ETFs were the ones that overreacted. I mean, the VXX to have done what it did, yeah, this is insane. This is definitely a massive, massive overreaction. And even compared to the VIX, which right now is actually quite reasonable, it should be about 30. 65 was insane, but you can see the volatility ETFs haven't really, I mean, it's still up 20%. UVXY is still up over 30%. So just one of those times where, yes, there's a correlation, but there's zero causation. Two separate markets. VIX does not. Some people say the VIX is up 10. How come this one's only up 5? You know, there's no relation like that. They are different. But over longer periods of time, it'll be tracking normally. Short term, day to day, it can be wildly different. Just so happens this time around, the VIX futures went absolutely nuts. So whatever was going on in the market, it did affect the VIX futures quite a bit. I'll be very, very interested in the next few days and weeks to figure out what happened here, because we don't know. Nobody knows. Everybody's guessing. Kind of have to do an autopsy when things calm down. All right, if we see some vol crush in the next little bit, what's the likely VIXM drawdown? I don't know. Like I said, it's expected. It's priced in, right? Anytime I go into something like the VIXM, the VXE, anytime I take one of those shots at long vol, basically 80% of the time it's going to lose money. It's just the way the markets work. When volatility spikes up, it's probably a fade most of the time, especially the day after, right? You know, it would have been ideal if we got the signal last Friday and we were just razor close. Just to give you an example of what happened last Friday, I mean, we almost nailed today's trade, but not quite. So the strategic tail risk was basically in the IYR range. The volatility barometer was something like 76, 77 last Friday when I sent the email at 11 a.m., but by 2 in the afternoon, it was already to 84. If I would have sent the email, 3 hours later, we would have been in the VIXM on Friday. And of course, today, we would have made not as much as the other ones, but we'd be up 9%. And then we'd be sitting on something with a profit already and sitting pretty good, right? If it fades tomorrow and it drops back down 5 or 6%, then great, we're still up money. As it happened, and this is just part of trading, especially if you're systematic and you're rules-based, and unless it's 82%, I'm not going in. If it's 81, I'm still in real estate. As it happened, we didn't quite get into it, unfortunately. Now, I'm not going to complain, because for the last 10 days, we've been in full safety and not lost anything. In fact, made money. So it would be a little ridiculous for me to complain, but that would have been nice. Overall, we will see. I mean, it's up 9% today. I don't think it'll unwind the whole thing, even if markets are up tomorrow. I don't think it'll unwind it all. But I would not be surprised at all if that trade lost 3, 4%, 5%, something like that. Again, the benefit is that there's going to be a time, and we all know the markets are going to crash, so you need tail risk somewhere in your system. And for us, that strategy goes to the tail risk and usually loses. But there's going to be a time when one of these crashes that's down 7% ends up being 25 or 35 or 50 or more. So that's what we're doing, is that you get paper cuts 4 or 5 times, and then you get a big payout. And I need that tail risk in my portfolio. I really do like making money when everything is melting down. And it's worth it for me to bleed a little bit, to take these little risks here and there. It's not really a risk. The system says to do it. And I just trade like a robot. I just do it. But yeah, to answer your question, no idea. Would it unwind the whole thing? No. Would it unwind a little bit? Yeah. And then maybe we'll be right back out a day or so later. I don't know. Again, like I said, would have been great if we just got a little bit luckier and we were in it already, but damn, almost. I would have been insufferable on Twitter. If I went into long volatility on Friday, I mean, people thought I was annoying today, I would have been off the charts annoying. So probably a good thing that we missed that signal. Why did the VIX spike so much when the SPY was down mildish? Like I said, there was something going on behind the scenes where it wasn't necessarily what was happening in the markets. My guess is it was just some sort of orderly, forced liquidation People got ahead of their skis. The market's been stable for a long time. People kind of forgot that volatility spikes and markets move both ways. And I think that's what happened. And it largely happened in the derivatives markets. That's why the S&P didn't really do a whole lot, but the derivatives markets went insane. That's what happened. Large players. It's not retail people panicking and rushing for the exits. If that was the case, S&P would have been limit down. I mean, VIX 180%, I would have bet a lot of money that the market was limit down. There's no way you get 180% VIX spike unless the market's already hitting circuit breakers. But what happened today was definitely behind the scenes in the, sophisticated institutional side of the derivatives market. Surprised at the large change in VIX minus VOLI. What are your thoughts on this, or is it relatively insignificant indicator? Thinking this means options away from at the money are more expensive relative to at the money. Yeah, right now it's a totally meaningless indicator. Just get everybody up to speed. VIX minus VOLI. The VIX index is a full strip of options at the money, in the money, out of the money, all these things. Where's our metric? Right there, VIX minus VOLI residual. The VIX index is basically measuring all strikes of S&P 500 options. The VOLI is very similar index to the VIX, right? It's a similar calculation. It's just at the money only. So when you subtract the at the money from the out of the money, it's giving you a picture of how much action there is outside of the money, like away from the money. Now, it's not really a main trade indicator for our large strategies, but what it is very good for is if you're an options trader and you're trying to choose between two somewhat materially similar trades, like a straddle, which is an at the money, or a strangle, which is selling the out of the monies. A straddle and a strangle are very similar trades, directionally, risk reward, except one of them is selling at the money options and one of them selling out of the monies. So if you've got a very low VIX minus VOLI residual, then that means that the out of the money options are very cheap. So you'd want to sell the straddle, for example. But right now, because the out of the monies are crazy, it's a 16 residual, you would probably, everything is happening out of the money right now. So you would default to the out of the money. Same thing with a butterfly versus an iron condor. Super similar trades, but if you've got a big VIX minus VOLI residual, you'd be better off selling the iron condor. If you've got a time when the at the money strikes are actually paying more, relatively speaking, then go ahead and sell the butterfly or buy the butterfly. That's how you do it. It's basically an indicator for option trading only. Super useful. I mean, as I always say, option trading is not about slam dunks and hitting grand slams. It's just about small edges, like reduce your trade fees a little bit. Sell the out of the monies if they're expensive. Sell the at the monies when they are. Just little edges here and there. It all adds up over time, and then you end up making money. It's not really about these lotto ticket slam dunk stuff. So good metric, but not for a day like today. Is there a short midterm volatility ETP? The ZIVB is the one you are looking for. It is the old one was called ZIV. It terminated, I think, July 20th or something, July 2nd, 2020, 2022, sorry. And no reason, it's just Credit Suisse shut down a bunch of their ETFs. TVIX was one of them as well. But then another firm came in and rebuilt it and basically did another ZIV called ZIVB. So it's M4 to M7, inverse, short vol. That's the one. Now, the only thing to be aware of is it is super illiquid. Like very, very few people trade it. I used to love the old ZIV. I was basically promoting it, 2014, kind of all the way up until Volpocalypse. And then it started to underperform. But the new ZIVB, you'd think it'd be right up my alley because I love the old one so much, but I actually haven't used the ZIVB yet. So it's just not going to catch on, unfortunately. The same firm's responsible for SVIX and UVXY. Both of them are doing reasonably well, but the ZIVB is just not going to take off. So I don't want to say skip it. You can take a look at it. The ticker's ZIVB, but we use SVXY for our inverse stuff. Sold all my UVXY this morning, double my money. There you go. Now, whenever people say double their money, the thing is, did you double your money on 1% of your portfolio, or did you double your money? because if you doubled your money on a small allocation, great, right? If you doubled your money on a large portion of your portfolio, I wonder what you were thinking, because going long vol really heavy before a crash, that is being a contrarian, right? And you're going heavy on the contrarian side. So not to nitpick you too much here, but hopefully you made a good chunk of money, but not too much that it would make me believe, wow, that, next time around, it's not going to work out so well. If you're trying to buy long volatility ahead of the spike, that is a losing game long term, my friend. That is a tough trade to make money on, because you get caught in one of those periods where you think the market's going to crash. It should crash. There's negative headlines, inflation's off the charts, and there's the markets just falling asleep, and you're just bleeding money day after day. That happens a lot. Like I said, long vol traders, people who like to buy UVXY, they tend to bleed more capital in good times than they will ever make back in bad times. Kind of like insurance, right? You will eventually pay far more money insurance in your life than you ever need when you actually get the insurance claim. But in many cases, they force us to get the insurance, so it's not our fault. But should I buy SVIX? I can't give direct investment advice, but again, I will say that all volatility products, including SVOL, for all you people that are going to come in and say SVOL is different, including SVOL, SVXY, SVIX, UVIX, UVXY, VXX, VIXM, VXZ, all of them. None of them are buy and hold vehicles. Absolutely none of them. So fortunately, there are also some very low-hanging fruit ways to reduce drawdowns. Like, we have a very complex system at VTS, and I send out those signals, but honestly, is it really that difficult to just not short volatility when the VIX futures are in backwardation? Just go on VIXCentral.com. 16% of the time they're in backwardation. Just don't short vol during backwardation. And if you want to be even safer than that, put it up to 2 or 3%. If VIX futures are less than 3% Contango, just don't short vol. And so you wouldn't be holding SVIX buy and hold anyway under that system. And you'd do far better just holding SVIX when the 3% or above Contango than you ever will buy and hold long term. Eventually, you're going to give everything back if you do that. So not personalized advice to you, but no, buy and hold is a non-starter for volatility products. Okay. Sorry, how are we doing on time? 47 minutes. We're ripping through these. How many more are there? Not too many more. Okay. Where's your question? Let's get back to this. Did the past changes implemented in SVXY and SVIX after Volapocalypse result in a smaller likelihood of a liquidation event? And at the market close or after market in markets like today? Yes. So I tweeted about this earlier today, but maybe I'll just expand a little bit. Volapocalypse 2018 happened because the volatility ETP space was very large in relation to the VIX futures market. I think it was something like 5 billion, 5.5 billion, kind of overwhelmed the VIX futures market. So you get a really bad day in the market. VIX was up, as you saw, 115.6. Is that the number? It was something insane. 115.6. And it overwhelmed the daily rebalancing at the end of the day. So what ends up happening is all of the volatility ETPs, not just the long ones, all of them, including the shorts and the longs, they all have to go out and buy VIX futures to rebalance for the next day. And it happened in a very short window. Massive liquidity crunch. And the underlying indexes that these futures or these volatility ETPs follow, they should not have crashed the way that they did. Should have only been about 35% down. But because of the liquidity problem in the VIX futures, it went from 35 to 96, and termination of XIV, SVXY got cut in half. You all know the story. So that's essentially what happened. Since then, the volatility ETP space itself is way smaller. It's like a third the size. So even if nothing changed, it wouldn't overwhelm the futures nearly to that extent. But then you've also got the introduction of SVIX and UVIX that use different methods of rebalancing. They use different underlying indexes, short vol and long vol. And then you've got the SPVIX STR. Sorry about all these, ticker symbols, and it's crazy. But the SVXY, for example, tracks the SPVIX STR index, the 0.5 daily inverse of that index. They made some changes there as well. So they widened the rebalancing window a little bit, but it helps a lot. They can use a trade at settlement market, which helps a lot when they need that. Because, of course, seeing the future when you're actually live trading in the market can cause some problems when you're going to have to do something at the close, but you have to do it before the close. So expanding that window helps a lot. Expanding the bid-ask spreads helped a lot. And long story short, that's a super geeky way to say, yes, everything is safer now. We, knock wood, should not see a Volpocalypse event anytime soon. The futures are plenty liquid enough to handle all the volume that's going through, and the end of day rebalancing is more orderly as well. So that was hopefully that was a one-off. Now, I have a metric that I track. I call it the Volpocalypse threshold, and it's basically measuring how risky we are, the ratio between the size of the volatility ETP space and the VIX futures. And if that thing starts to get some red flags, of course, I will notify everybody on Twitter and, live streams and whatnot. Right now, it's the likelihood of a real liquidity crunch is super low. I won't say it's impossible. I mean, you never know, but today was looking like something nuts was about to happen, but seems like it's reversed now. So yeah, overall safer. All of the underlying indexes are improved, and the short vol trade is basically a third of what it used to be. Lucky us, we're still making good money on it. So I don't know maybe they abandoned it and went to Bitcoin. I don't know, but I've always had a short vol allocation. 20-30% of my portfolio is always dedicated to short vol strategies. That will not change. The short vol trade's not dead. It's just, its glory days of 2012 to 2017, they will come back after the next recession for sure. So I like it still, even though most people have moved on. I know you said many times not to directly short VXX, although I'm trying it out of curiosity given this unique case. It's working, but would you close this immediately due to the risks? So I'm going to have a drink of coffee here and give you a 50-second warning on why you shouldn't short volatility ETPs directly. I don't ever short the volatility ETPs directly. First, there's big fees involved because you're borrowing shares to short, and it's not cheap. This is many multiples more expensive than standard trade fees for some of the other option trades, so this is always a major headwind. Second, they're not always available to borrow. You might think you've got a great trade setup that you want to jump in on, but if there's no shares to borrow, then what does it matter? Third, you can have your shares called away on you at any time, so you're not really in control of your own trade. Plus, you should know that the time where they are most likely to get called away on you is when you least want them to be. Probably it's going to be when you're doing damage control on a trade that isn't going well, and you might want a little extra time to fix your trade, but you're not going to be able to because the shares get called away on you. And lastly, and probably the biggest reason here, when you short shares, you have unlimited loss. We're talking about volatility ETFs here. They can spike up hundreds of percent, maybe 1,500, 2,000% if you're talking about the UVXY. Why on earth would anybody trade unlimited loss when one flash crash will wipe out your portfolio? Yes, why indeed. So whoever that guy was, pretty smart. So yeah, I would say, again, I can't give you personalized investment advice, but I do not short VXX or UVXY shares directly. And a lot of people think it's because of the risk, because of course the risk is part of it, but mostly it is an efficiency issue. It is just, there are just too many better ways to short volatility than that. It's the same problem that I have with selling naked calls on UVXY. I've never said that that can't make money. The problem is it is incredibly inefficient. The risk-reward profile is very skewed, and you do have to get lucky to make money long-term with that. But it is an efficiency problem. It's not really the risk necessarily. So no, you just, defined risk, you're always going to be able to get more money into the market. You're always going to be able to define your parameters better. And that's what trading is all about. You know, it's kind of like I said with the other person who doubled their money on the VXX. That's awesome, by the way. I'm super happy. But when you're doing those types of trades, you just can't put very much of your capital in it. And if you want to make money long term, the point of trading is to get the maximum amount of money to work with the least amount of risk. But if you're doing these super risky trades, if you're selling naked calls on UVXY, great, they typically do make money, but you're talking about a tiny portion of your portfolio, right? You're not going to put 30% of your money into that. One flash crash and you lose not 100%, you lose 300% of your money. So you owe the bank money for 5 years and they garnish your wages and, you know, they will come for your money. They don't just let you skate when you're at zero. You go negative, your life is ruined. So yeah, it's really just about the efficiency of it all. And fees, I don't know how I can, let's check the fees right now of something like, where is the fees? I know I've got something here. Did I screen share? Can't find the fees. But, you know, something like UVXY, for example, I didn't even screen share. Good job. They can be, you know, 20% or more. VXX is typically more reasonable, some 5-8%, but you've always got that headwind. Your shares can get called away. That's super annoying. No, there's just too many better ways to short volatility. To get your money to work safer is the name of the game. So I wouldn't mess around with that stuff. I'm not telling you to sell it, and I'm glad it's working because, of course, it's working. Volatility suppressed a little, but that's only a few hours. We are a long ways from the all clear. Stock replacement for VIXM. Yeah, this is tough because there is a way to do it, of course, but the last thing in the world you want to do is buy long call options on VXX on a day like today, just paying way too much vega. So it has to be done with verticals, and I should do a private live stream explaining all that. So for anybody wondering, stock replacement for our strategies, especially our volatility strategy, I actually do give trade instructions for stock replacement. So there are people, certainly Europeans, who can't trade US-based ETFs, but also people maybe in tax-sheltered accounts, certain types of IRA-style accounts. They might not be able to trade some of these. So actually we do VXX put options, long-dated, and these are available to everybody. They're just single-leg, long-only options, and everybody can trade these, even Europeans. But when you're dealing with something like VXZ and then the VIXM here, it gets tricky because right now volatility is through the roof. Last thing in the world you want to do is run into a Vega headwind. So there is a course, but the one thing that is excluded right now, I think there's about 15 lessons in this course. I think one of the lessons missing is doing the verticals. So thanks for the reminder. I'll do a live stream, maybe make it public, just include everybody, teaching you how to simulate long volatility in an IRA account. There's a way to do it. It's a little bit less efficient. If you can get the VXZ or the VIXM done, then that's great. VIXM is the ETF, VXZ is the ETN. So perhaps you're struggling with one or two of those. You can use them interchangeably. They're the same thing. So try both of them and see if your broker will let you get something through. I don't know. I'm not American. I don't have an IRA. My plan has been to invest in both UPRO and VOO and to take extra wins from UPRO and invest them into VOO. What would be the best timing plan for this? What would be the point of this? They're the same thing. You're just messing with leverage. So why not just kill the middleman and just use a 1.3, 1.5 times S&P? You know? I don't know. Why not use something like the SSO, which is a 2 times S&P 500, and then just reduce your exposure a little bit and maybe do 70% in SSO and 30% in fixed income and kind of forget about the whole thing. I'm not really sure. Maybe I'm missing the point here. You're taking your profits from the leveraged S&P and putting it back into VOO. I see no point in this. They're the same thing. I view them as the same thing. There's different leverage factor. Yeah, simplify your life and just hold something in the middle of both of those, I would say. Relatively new, so pardon my ignorance if this sounds silly. There's no dumb questions. How might a call ratio spread do in times of increasing or decreasing volatility? Well, they do pretty well. That's why I said that you can do long put verticals, you can do short call verticals. They are mathematically identical. One of them is not long vol, one of them is not short vol. They are both relatively neutral vega. Like basically the only difference is the difference between the strikes. If your strikes are super wide, then they are going to be long vega. But if your strikes are quite close together, if you have if you're a retail trader and you've got a smaller account, as long as you're not trading millions of dollars, you can probably get your strikes to be quite close together. And then it's a very low vega trade. And then they perform well. It's just mostly a delta directional position at that time, right? That's what you want to do with options during a massive spike. You want to at least minimize that vega factor. But if you can, maybe an iron condor would be better. You can shift it over to the direction you're looking for. But yeah, perform fine. Absolutely. In days like today, you always want to do spreads. Long and short options in the same spread. Don't buy long options today. It's just too frustrating to watch your option get sucked out all that premium as soon as volatility declines. I'm YOLO SVIX today. There's no way another big spike like last night is happening this week. I mean, you just jinxed yourself. You are taunting the investing gods with statements like that. I hope this works out for you. I have been doing this for 18 years. I'm not even that superstitious, but I would never say something like that out loud. There's no way. Really? There's no way? Dangerous, my friend. Not a trade I would do, obviously. I've ranted plenty today on the fact that these are not instruments you want to do that on. VIX futures are backward. This is not the time to short vol. If you want a short vol, you do it with defined risk options. And then fire away. I mean, you can always get into the option market, defined risk, and set up your trades. The last thing you want to do is take an unlimited loss trade. Market's only down 7%. If whatever's bothering the market that spiked the VIX 180% in a single day, let's say overnight, over the next day or two, we find out that it is actually a big deal, that it really is something structurally wrong. The SVIX might have, hundreds of percent to go. It could be just the start of something terrible. To throw out a statement like this is it, I don't know. I hope you're right. I hope you make money, but wow. Trading gods are laughing at you right now. What about CFD trading VIX? You can. I have an article, especially for the Europeans, that ETF replacement, there's always European versions of that. Then there's options with stock replacement. And then there's, if you want to get into the CFD market, it can be a little tricky. And I don't teach it because my email inbox will blow up. But I would be super wary of the fees that you're being charged. That's the one thing to be concerned about with there. And then pay super close attention to these if you're actually doing it, because they have a way of being extremely expensive. So, but you can do it, of course. If you're a sophisticated investor, it's the same thing I always say in the futures markets. We don't trade them within our strategy because we have a community. I can't be doing super complex stuff. I'll just be overwhelmed. But if you're sophisticated enough, you can do it yourself. The fact that you're even asking means you kind of know what you're doing. So go for it. What kind of stop loss are you putting on positions? No stops. My stop loss is the volatility metrics dropping back down below this threshold line. So we will just simply be watching the volatility barometer. When it drops down below about 82%, all three strategies use different volatility metrics. We've got a list of several in every daily email, but they all use a different combination. Some of them focus on different aspects, other things that aren't included here, but there is no stop loss on that position. It is just When volatility declines enough to get kicked back out, then we're out. Other than that, fingers crossed. I have a profitable long day trading strategy, and I'm wondering if I can use an option strategy to improve it. I know nothing about your strategies. I remember talking to you maybe last year saying document everything. Make sure you start building your track record, because I remember you are trying to go in the direction of asset management and building a community. So hopefully you've got a year track record going at this point, and it sounds like it's going profitably well. My knee-jerk reaction is to say that an option overlay could always improve everything, but I know nothing about your strategy, so I don't know. If it's going well, it's going well, right? You don't have to squeeze every last drop out of it. If it's going well, then simple is sometimes best, but I'd have to know way more. Good luck to you, though. I know you've been working hard on your systems, so hopefully they're going well. All right, call ratio spread on something like, UVXY, it's all good. It's all good. As long as you are reducing your Vega on everything you do today, get your Vega as low as possible, you're probably going to be fine. For years, and you always say not to short vol in backwardation, but the best times to short vol is after a panic and vol spike. Then they're in backwardation. This is just mathematically not true, though. That's why I keep saying it, is because it is just simply not true. If you can do this yourself. I have that volatility spreadsheet that I offered free for everybody. You can download it, and you could test this yourself in 15 minutes. You could just look at the results of shorting the VXX when the VIX futures are in backwardation. That's your answer. Mathematically speaking, this is just I'm not trying to call you wrong, but this is just wrong. The most dangerous and the least profitable and the worst time to short vol is when futures are in backwardation. The best time, the easiest time, the best risk reward time is during mid to low vol. It's during stable markets. That is just factually true. So I'm sure you can pick out examples where if you were to have top ticked it and you said, oh, I would have shorted right there and it would have been perfect. Absolutely, those exist. But stretch it out over 15 years, it couldn't be more clear that 4 out of 5 times you win, and you win a little bit. 1 out of 5 times you get absolutely decimated, and that hurts you way more than the 4 wins helped you. So that's what's really going on here, is that the person who said, you know what, I'm going to short volatility on Friday, February 2nd, because the VIX futures were 4.6% backwardation on February 2nd. And I was all over Twitter saying, careful, don't short vol during backwardation, be safe. People were yelling at me, all that stuff. Weekend goes through, Friday, February 5th, Volpocalypse happens, or Monday, February 5th, and you're done. That's it. You just ended. But there's a lot of other times where it would have worked out for you. Maybe today. Maybe right now, if you would have shorted vol an hour ago, you're going to make a ton of money. That could be true. But there's going to be periods where you're just done. All right, what is it? August 21st, 2015. VIX index spiked, I think, 45%. I can even get the exact numbers if you want. My memory is, that was a long time ago, but I was trading then. 44, 45, what was it? Where is 2015? August 21st, 2015, that's a Friday, right? VIX is up 46%, comes back Monday, it's another down day, down 4%, and you're done, right? This is what happens, that every now and then, that strategy will absolutely blow you out of the water. So I totally agree that a majority of the time, it seems like the smart thing to do, to wait till volatility spikes and then short it. It seems like the right thing to do. And anecdotally, there's definitely stories out there of that working out brilliantly. But trust me, go through the numbers, drag it out over 15 years, and watch how bad that works out, right? It's just not smart. So the reason I say it is because in this case, not to be the, up on a pedestal, but the reason I say it is because it's true. And I'll continue to say it over and over again. It is just a fact that the most dangerous time to short vol is when volatility is spiking, because it is a very short trip. The VXX goes from 20 to 40. It's a very short trip to 100. It just is. So be very, very careful doing that. Can't tell anybody what to do or what not to do. Can just show you the numbers, but it is actually quite obvious. You know what? I'm going to give this stupid website of mine another shot. Should we try this again? Try the search function? Let's go one more time. I promise you I have written something on VIX deciles. Come on, don't fail me. VIX percentiles. I know what is going on. Give me 30 seconds. I know it's terrible to watch me fumbling around here, but I promise you. Oh, I know what I did. I did a live stream. One of these live streams. I basically went through all the numbers. I showed them live. So obviously my titles are awful because even me who made the video can't find the stupid thing in my titles. So note to self, stop being an idiot and labeling these things this way. You'd think I'd be able to just spot it and find it immediately. Oh, God. Okay. Hand gestures it is. So what I did was I divided the VIX index into 5 quintiles, basically, 20% ranges. And I showed the results of short VXX during all 5 ranges. And wouldn't you know it, the worst one by far was 80 to 100. So the reason isn't because sometimes it doesn't work out. It does. Sometimes it's a slam dunk. But there are definitely times when you're just like, oh my God, like this guy above, the guy who's taunting the trading gods. Where are you? Mr. Lin, right? Kim, sorry. Our friend Kim here taunting the trading gods. There are times when they just say, oh, you think this is the worst it can get? Okay, I'll show you. Show you what the worst it can get. You can get hit like the day after. You'd think today's Volpocalypse and then tomorrow's the actual Volpocalypse. It can happen. So I would go through the numbers. You'll prove it to yourself in 10 minutes. Just download my spreadsheet, do a very quick back test, and you'll see it. All right. Initial jobless claims data on Thursday, which could speak to the same concerns as on Friday. It isn't impossible to have another bad day this week. It's not. Everything's on the table. So one of the easiest things to see right now is that there's just this kind of long-standing pattern. And this isn't trade advice, by the way. Don't act on this. This is just anecdotal stories from one person. But I have noticed that it is a fairly predictable pattern that the day after a devastating day, and this isn't rocket science, most people know this, the day after tends to calm down, right? It is quite rare that on a Monday to Tuesday that there's another Tuesday massive down day. Friday to Monday is pretty common, but Monday to Tuesday, less common. I would not be surprised at all if tomorrow's an up day. But we won't know anything this week until the week's over. And we won't really know anything for a couple of weeks. So yeah, it is, everything's on the table. Something happened behind the scenes today that was really, really bad. Massive amounts of money liquidated. Just insane amounts of money were out of the market. Something happened. Did it happen and now it's fixed and there's no more selling? I don't know. But it would be foolish for any of us to think that we know something, right? So again, I trade like a robot. I'm just going to do what's always worked for me. You guys do what you think is best, but my only advice would be defined risk and avoid walking into the Vega headwinds. Don't you think it's a great time to open put calendars? During backwardation, they work better than in low vol. Again, I would say no problem because you're dealing with a long and a short, so your Vega is going to be fine. I didn't look at the VIX futures too closely. Is it consistent enough for calendars? Because the one thing you don't want to do is walk into one. Of course, a calendar is just different expirations, and you can get hammered on one and not the other. Personally, I wouldn't do calendars now, but that's not because it's a bad trade. It's just, for me, not so much. I like calendars more, and maybe this is just past experience, but I like calendars more when the crash has been happening for a while and there's more consistency between the strikes. what you'll find sometimes in these, it wasn't out of nowhere, but this has all happened pretty fast. Like the VIX was in the teens 3 days ago, and now it touched 65. The month-to-month expirations, they're all out of whack. So you could open a trade that looks really good, and then the day after, it's just an absolute mess. And I don't like that. I like to see the market somewhat have a decent idea of what's going on, and then you don't get hammered by those unpredictable, oh, it was just Monday, this expiration was elevated to the extreme for some reason. I'd like to see them super consistent for several days before getting into calendars and diagonals. Tough trade when the market's moving around a lot. I like to stick to stuff like iron condors, butterflies, keep everything same expiration, shorts and longs, and typically short Vega. But do your thing. Is the volatility barometer an all-time high? No, it was at 87.45. And the all-time high, I believe, is 90.3 or something like that. So all-time, you can see it here. Well, it's not super clear. Can I blow this up? It's not totally clear, but no, we're not at an all-time high yet. It has touched 90 twice, but close. Like we are in the top 1 percentile for sure. Yeah, naturally, right? Actually, our whole thing is red. The whole thing is red. The only thing that isn't red, of course, predictably, is the volatility risk premium, because that one will be backwards. But our volatility dashboard is just extreme percentiles across the board. Not everything is extreme. This is why we use so many different metrics, because you can see it doesn't all say 99 and 1. These are different, right? You've got to track multiple different areas of the market. You can't just look at VIX futures. You're going to miss a whole bunch of stuff. Can't just look at the VIX. It's a terrible indicator. But when you combine them all together, we're definitely in the top. You can see it here, 99.1 percentile. So there's been about 1% of days that were worse than now, but it's as extreme as it gets, I would say. Better tax with BOXX trade. Oh, missed one. Yeah, I already know where you're going. Yeah. Instead of SHV, we can use BOXX. Yes, you can. BOXX, I believe. Sure. You can use SHV, you can use SGov, you can use BOXX, you can use any of the short-term fixed income stuff. It's just that SHV, basically the only difference, the yield is going to be about the same. It's just SHV is paid through distributions, and the BOX, I think there's another X. It's BOXX, isn't it? It's not distributions. It's just, it goes up basically 5% a year. Now, right, that will change with rates, but as of now, yeah. I think I mentioned that in the course, though. I think I mentioned all 4 of the main tickers, and different people can use different ones. Some people like the dividends. They like the distributions. So SHV, if you just want it steady money, then BOXX. Sorry, I need to, oh no. New investing and have small account. Does your service work? Can't give out any direct stuff, and I don't like to talk about my live streams are all free for everybody. 10,000-ish, it all works. If you have a small account, then what I would always suggest is don't trade the full 5 strategy, right? That's not going to be efficient, right? The difference between, say, obviously the difference between buying 2 ETFs, 2 shares of an ETF, and 1 share is massive difference. The difference between buying 51 and 50 is negligible. So the more capital you have, the better off you are, especially with iron condors. The difference between 1 or 2 contracts can be quite big. So if you have a small account, of course you can still trade with VTS. You would just probably choose. I would always include an iron condor, and I would always include one of these 2. So if you do have a small account, like $5,000 or something, you'd choose one of these. Performance-wise, they're about the same, 30%-ish annualized per year. It's just that this one directly uses short volatility, and this one uses the NASDAQ index. But they're both our high-performing strategies. And then iron condors have no correlation to the market, so it does smooth out performance over time. These are only at about 16 or 17% annualized, but it's a very important part of the portfolio, I would say. So you could easily choose one of these two and then trade Condors. And you would just do that and then save as much money as you can. We all started at the same place, 0, so absolutely okay. And yeah, work hard, save money, stuff as much as you can in your investment account, and you're good to go. Okay. I should have added when spot VIX is above 45, what your spreadsheet says about the strategy if we add only short when VIX is above 45. Well, you've got about 5 occurrences at that point. But, I mean, of course, the question would be, how much capital are you talking? Because this is an unlimited loss trade. 45, the VIX can go pretty high, right? It has gone into the 80s, and it can, I mean, Black Monday 1987, the old VXO went to 172. So the VIX doesn't cap at 100, it just goes, right? So it'd be a pretty uncomfortable drawdown if the VIX went from 45 and you shorted, especially shorted heavy, an unlimited loss trade, and it went to 150. That would be an uncomfortable moment. You'd probably get margin called and out. So you could be a profitable trader for 20 years, and then you get hit with a single day flash crash and you're done. Why? It doesn't make any sense to do that. Plus, you've only got about 4 or 5 occurrences. VIX doesn't get above 40 very often. European debt crisis, 2015 China scare, once in 2018 briefly, pandemic, of course, today financial crisis. You've got 6 in the last 17 years. So it's not even a good moneymaker anyway. Why mess around with something that's only every couple of years you get a shot at it? I want as much money as possible in the market, as safe as possible, so that I could just make money all the time, right? I don't want to do these, if this thing happens once every 4 years, this is the trade I take, because even that could fail. And then what? You waited 4 years, you took your shot, and it still failed? I'm not trying to discourage, sometimes I sound pretty negative, but obviously do your thing. You crunch your numbers. You probably know better than I do, but it's just not for me. No, you don't short vol when the market's melting down. You just don't. It's just a rule of thumb that pretty much every volatility trader who's been around a while, who's done this for 10 years or longer, they'll probably tell you the same thing. If some people are new and they're using recency bias, they might be able to talk themselves into it, but eventually you learn the lesson that when you say, well, this is as bad as it gets, no, it's not. It is absolutely not. And you will learn that lesson the longer you trade. So I went to go buy a grandfather clock in early 2018 whenever XIV or whatever the ticker was imploded. Got stuck in traffic, and if I had made it home, I'd have bought at least 30,000 worth. So every time I look at the clock, I remember how much it is actually worth. That is funny. That's a good story. What was I doing? I was in front of my computer arguing with somebody on Twitter when Volapocalypse happened. I remember it. I'm not going to say who it was, but some of you probably know who it is. Person saying it's the golden opportunity to short vol, and me and him were going at it for a while, all day. And then, of course, one of us was proven right at the end of the day. But that's where I was during Volapocalypse. Could you explain why it is risky to hold SVXY? Because the drawdowns can be 95% or more, and not just Volapocalypse. If you look back through the history of SVXY, back when it was a one-times product, it had multiple drawdowns. It had an 88 and a 93, and that was without Volapocalypse. It's absolutely disastrous. And then, of course, the old ratio that if you lose 90% of your capital, you need a 900% return to get back to break even, right? You lose 95% of your capital, you need about 2,300% return after that to get back to break even. It's not make 50, lose 50, you're at the same spot. Losses are devastating, and it can take a lifetime to get back. If you buy and hold SVXY or SVIX or any of these things, and you get caught in one of those big drawdowns that is definitely coming eventually, you will spend the rest of your life digging out of that drawdown. There are a lot of people that, even Twitter, even people who manage services on Twitter right now, and they say they manage clients, when they had drawdowns of 80 and 90% in the past, And then they're posting, well, in 2023, I made 80%. In 2024, I'm up 50%. It sounds great, but you got to remember that you're 2,000% away from breaking even because of what happened 5 years ago. So you can make 50% a year for a decade and you're still not going to be back to break even. That's what happens when you make one of those epic mistakes. And the volatility market, there's no faster way to lose money than to take on these insane products without knowing what you're doing, without defining your risk, and without exiting to safety, and without having risk management. So I hope I've sufficiently scared you. Yeah, drawdowns can be insane. And we're not even talking about a flash crash, which I think personally is probably also coming at some point. I think there's probably going to be some type of global cyber attack of some kind. It would just be insane to be holding such risky positions. You got to balance it all out. So thanks for getting us into safety beforehand. Yeah, it's been good. It's worked out really well. It'll be interesting though, because there's always give back, right? There's always, we exited to safety. Right now, our differential is like 30% in one of our strategies, but there will be give back. There will be that day where SVXY has a nice big recovery day, be up 5% or something like that, and gold will get hit down 2%, and you'll think, oh, gave some back. But you got to remember, and please watch this video that I uploaded today. It explains it much better than I can. Watch my most recent video because, again, we don't cycle to safety to make an extra 10 or 20% differential over a week when the market's down 7%. It's not why we exit to safety. It's great, and this week's been awesome, but we do it because there's going to be a time when the market's down 30, 40, 50, and it's just going to be as clear as day why we cycle out into safety. It's just going to be like, you saved me 10 years of my capital because of this move. This week, it's kind of cool, right? But I'm not all over Twitter bragging about how well we did. It's just, there's going to be some give back, right? But there's going to be a day where it's just like, yeah, I cycled into safety, saved myself 50%, and the market is collapsing and it's down for 4 years. Got to remember that the stock market, when it finally goes, inflation adjusted, it could be down for a decade, 15 years. Like after the dot-com bust, inflation adjusted, the NASDAQ took 17 years to recover. S&P 500 took 14, 15, something like that. You're talking about over a decade of being in a drawdown. For me, no thanks, right? I'll take my paper cuts when I get whipsawed around, no problem. It sucks when it happens. Like I'm in the VIXM, might lose some money tomorrow. I'll take the hit, it's fine. What I don't want is a 15-year drawdown once every 15 years. I mean, that's just, no thanks. Here's our, there's no way that it can go further guy. I'm being so hard on you. Sorry about that. Recency bias goggles. No, you are probably right. You're probably going to be fine. Like I said, about 80% of the time, volatility spikes are a fade. 20% of the time, it's potentially career ending if you don't make the right decisions. The reason it is particularly risky is, I would assume the short vol stuff, is because volatility clusters. We're used to mean reverting behavior in the market, but volatility spikes are exactly what you can't depend on. That's a good way to say it. Yeah. Again, coupled with recency bias, I can totally see it. This is why I don't, I'm not super hard on people when they do this stuff. Even for people who buy long volatility, I'm not hard on them because there's plenty of times when you can just see with your own eyes it worked perfectly, right? It's just that very few people are as, geeky spreadsheet like I am. Like I crunch numbers for the last 20 years and I can see that, oh, you think that strategy was awesome in the last 3 years, but look at what happened in 2013. Like, are you even aware? Do you know what would have happened if XYZ? And people just don't run those numbers. So yeah, I'm trying to be as dispassionate and polite about it as possible, but volatility is not to be messed with. So you are realizing your losses even though you are just holding SVXY shares. I don't know who you're talking to. Oh, You asked this, I answered it. Okay, I missed one, sorry. Wouldn't it eventually calm down and on average doesn't take long? Well, like I said, it could take a decade, so don't make that mistake. So you're realizing your losses even though, well, yes, this is another thing that people are often confused about, the difference between realized and unrealized gains. Money is money, right? If you have money and you're down, you see people say this all the time. Well, I'm not actually down. I haven't sold it yet. Really? Because unrealized losses are still losses, right? If you have an unrealized loss of, say, 50%, you have a choice that day. You can tough it out and you can say the old, it's not a loss until you sell. You can do that. Or you can just say, okay, I have half my money left. I can take the money out and I have a universe of 5,000 stocks to put my money into that might have a better chance to recover. Or there's 100 different strategies that I could use to recover this money faster. Or I could just keep it here and say it's not a loss until I realize it. Down money is down money. It's the same thing. Realized, unrealized, doesn't matter. When you do this, you will watch your net worth go down and stay down for a very long period of time. That's what's going to happen. It's not often, so people can't see this happening a lot. But every 5 or 10 years, it's just going to be a stark reminder of why you don't mess with buy and hold volatility. I don't know if you can see it on an SVXY chart anymore. How far back should I drag this thing? 10-year daily. What's it showing? I mean, if you want to see what happens, this is what happens. Like this, again, you're going to get people on Twitter all the time here and all the time here talking about how much money they've made on SVXY. Oh my God, I made 60% last year. I made 50% in 2021. Look at how awesome I am. Yeah, but you lost 96% here. It's going to take you 15 years to get that back. So sure, if you just say, hey, what's happened's happened, I'm going to start over right here, great, but your net worth doesn't get to start over. Your net worth was here, and then it's here, right? You went from split adjusted $278 down to $20. That's going to take you pretty much a lifetime to recover from. So it doesn't happen often, but when it happens, you're going to really wonder why you didn't just do something as dirt simple as don't short vol during backwardation. Just that. That's the rule. Gets you at least halfway there to not blowing up your account. There's a lot more you need to know than just that, but that gets you halfway there. Super low-hanging fruit. Honestly, yeah. There's no point trying to force bad strategies. It's like people who are selling naked calls on UVXY, right? Terrible strategy right from the start. Super inefficient, capital intensive, crazy. Oh, but what if I do this? What if I hedge it this way? What if I have a layering system where I put in 10%, then 20, then 30, and I martingale? Yeah, or just don't do the crappy strategy from the start and do something better from the beginning. That's my style. So again, today's live stream probably sounded like I'm just trashing some people. I'm catching myself sounding negative, but hopefully I've sufficiently scared you. A 95% drawdown is no joke. It's life-changing, and not in a good way. All right, I think this is the last one. TLT and SPY seem to be uncorrelated again. Would it be possible to use TLT again as a safety position? So TLT is only good when, and we used to use it as well in strategic tail risk. Instead of IYR, years ago we used to use TLT. It's fine if interest rates are at the very least stable, if not going down. So there are plenty of times when bonds are actually a decent safety position. Are interest rates going to be going down? Yeah, maybe. I mean, there's talk all over the place of emergency rate cuts, 50 basis points maybe this week, another 50 basis points at the next scheduled meeting, maybe another 25 or 50 in December. There's talk. And so we're kind of at that stage where, yes, it would work. But what I would say is that IYR real estate will also work for the same reason. When interest rates are going down, IYR has a little bit of a tailwind as well. and XLU utilities will really do well. So even though TLT is becoming, for 3 years, it's dead money. Now you could start considering subbing it back into your strategies, but there are still better choices, right? If I had 5 tactical strategies, for sure bonds would be in one of them, but we've only got 3. And so right now we're using gold, utilities, and real estate. Maybe even if I had 4 strategies, bonds would be the next one in line. It would either be bonds or maybe one of the dynamic sort of managed futures type ETFs. Could be one of those, but yes and no, right? Yes, in the sense that as long as rates aren't going to go up anymore, TLT is not going to rip your face off. But I still don't see it as good as utilities or real estate or gold. Safety, safety. Do you think VXX has had its rise? I would assume you want me to call the top, right? Look at that S. Just one more look at it, just so everybody knows what they're dealing with here. This is not pretty. It does not matter how much money you made here if you already lost all of this here, right? Anyway, you get the point. Let's do VXX. Am I going to call it? It's up 26. What's going on? Is the market crashing again? Down 2.5. See, it's not, the market's not settling yet. The VXX, the market is down 2.5%, and it was only down less than 2% Friday. And the VXX is up from 45, it's up double. It's doubled in 2 days. I'm telling you, on the one hand, I would not be surprised at all if tomorrow's an up day and everybody fades this move, because typically volatility gets faded. 80% of the time, the right play is to just fade it. But I'm telling you, something really happened in the market, and it's very unclear right now. We don't know what happened, but this action, this is either the world's biggest overreaction by a mile, or we're going to find out something in the next few days that scares us even more. I don't know. I know for sure I'm not going to mess with my strategies. I'm going to follow them like a robot. I'm in safety now, and I'm going to stay there. Even if I get hit a little bit on the way out, sometimes, you know, tactical trading, you do get kicked a little bit on your way out the door, but I'm waiting to get kicked because something's going on here. This is insane. VXX up 25% again today. I thought it was insane that it went up that much Friday. To do it again today there's something going on. I'm not going to call a top. I'd say 70% chance the market slowly bottoms and recovers here. 30% chance we're in for a month-long news-filled, ugly market. There are going to be news headlines coming out that scare the market. I should understand more about SVXY. It means I don't know how it's working. Yeah. Sorry, I was so rude. But yes, it is not to be messed with. Volatility products are either the greatest investment opportunity pretty much there is, or it can just end your career, basically. Why is cash VIX backing up while futures are firm? It is interesting. Like earlier today, when the VIX was up 180%, it would be silly to say that the VIX wasn't the one that was leading. But the volatility ETFs are the ones that are staying sticky. The VIX has come down. The stock market's not as ugly, but the volatility ETPs and the VIX futures market is the one that's staying sticky. So don't know what's going on in the futures. Like I said, they're not the same market, and institutions have their rules and their strategies and the methods of hedging, and sometimes these two markets can decouple from each other. It seems right now, whatever's crazy blowing up the market, it has something to do with institutions and the VIX futures, or futures markets in general. But the VIX futures, there is something in there that there was some liquidating going on. Where is another guy I respect on Twitter said the exact same thing. To what? I like being right, but what did he say and what did I say and who agrees with who? I can only see one of your comments. I can't find anything else. You said another follow-up. Analysts aren't realizing the gravity of the Japan thing. The only guy I follow on Twitter who's just all over the Japan stuff, don't know how to say his last name, Michael Gayed or something like that. I follow him, and he's been doing victory laps all day long. So maybe you're talking about the same person. Have you looked into I don't know about the Japan stuff, by the way. I don't follow it too closely. Have you looked into rolling year? I would assume greater than 1 year, VXX LEAPS. Again, you're going to run into the same problem. You're buying a massive Vega headwind. And if anything you buy, any option you buy that's Vega positive right now, when the market fizzles out, whether it's a day or a month, when that happens, option is going to tank. So it doesn't matter if you do a month, 3 months, or 1 year. At some point, the Vega is going to be pulled out. What is volatility on the VXX right now? A typical contract would be sitting at around 60%, right? We're at 137% vol right now. 130, and look at these, 165, 163. What is, I mean, a typical contract might be 50 or 60. So you're talking about, remember what Vega is. Vega is how much your option value will change given a 1% change in volatility. Right now, Vega is roughly 80% elevated. So you're talking about your option contract is going to suck out 80 times that 1% move. That's what Vega is representing. So it's just going to chunk down as soon as that volatility exits. So I don't know if you meant like a leap strategy when you're doing a spread. That might be okay, because then again, Vega's negligible. It'll be slightly positive, but pretty negligible. But if you're talking about a leap VXX, boy, that is not going to work out well. For all the same reasons I just hammered all over. We're at 1 hour and 40 minutes. We should call this a day. Okay, last question. I got a call. I didn't know we were going for 1 hour and 40 minutes. Sorry about that. We can easily just come back tomorrow if there's this many questions. I didn't mean to drag on this long. I shouldn't do that. I seem to remember you said that anyone who wants to follow your strategy should just enter whatever positions your strategy is in at the moment. Is that still true now? I would say yes, but there's 2 ways to do it, remember. So just for example, the one way, let's say you joined today, you would join and you'd buy gold, you'd stay in cash here, you'd buy VIXM. That might be frustrating if it goes down tomorrow. We're exiting this Iron Condor. We'll open a new one tomorrow. It's an awesome time to open Iron Condors right now. Of course, Vega negative trades, killer time to open this. And this one's in cash, right? We don't do this when we don't have offsetting positions. So this is in cash. So you have 2 choices. You can either enter everything now as the portfolio sits, or you can just wait for the next change of direction. Either way works, right? You could wait until we either go into SVXY or VXE. We're in cash here, so you could wait until we go into XLU again, which eventually we will, and you could enter it there. And same thing here. You just wait for the next change of direction. Either way is totally fine. I'll be here for decades. What you do in the next 1 day to 1 week, unless you do something really stupid, like naked calls or something like that, but anything you do with VTS, it's just going to be a tiny blip on whatever 10, 20-year time horizon you have. So you either just enter them as they are or just wait for the next change of direction. Either way is totally fine. Okay, and everything else, sell high Vega, VXX puts. Yeah, at least you're on the right side of it. Only problem there is, how could we even realistically guess how far the VXX is going to crash when it finally settles down? That's the only problem is, how far out of the money do you want to go? Because if we all find out this is a big nothing, this is going to be the fastest unwind of volatility in history, right? If it's something real big, you could be sitting on something that, I don't know. It's better. It's definitely better. You know what you're doing, like wrong on Delta, right on Vega. Yeah, you know what you're doing. Just don't walk into the Vega headwind. All right, I'm going to put together a video. It's 10 o'clock tonight. I'm going to be working all night. I got to get that Vega video up on the website. So tune in, subscribe, hit the like button, of course, but subscribe to the channel because this week, next week, we're going to do a bunch of stuff. So thanks. Sorry I kept you so long. We'll be back real soon because this is crazy, crazy market. All right, good night, everyone.